Well, that's what the market is dealing with here. And, you know, I was saying in recent days, one of the reasons the market was just sort of so concentrating all of its anxieties on the tariff announcement is because it bundled together all the things that the market's been struggling with: the risk of a deeper slowdown, the stickiness of inflation, and the possibility of erratic, capricious policymaking that just seems about aggression and not about let's come to some kind of a better balanced solution. So I think we got basically the worst of what you could have thought you were doing. The market was taking a probability-weighted approach to say, let's price an outcome here, and we got something that was beyond the spectrum of what they thought. Now, what does it mean to me? I would think the question this morning is, why is the market down more? And I think there are good reasons why the market's not down more.
Why isn't it?
Yeah. First of all, where we came from, okay? You already had a market that was falling for 6 weeks, more or less. You retested these levels. We undercut it this morning on the S&P 500. You've had the median stock in the market down like 15, 16% from an all-time high. In other words, we weren't sort of stuck out on a maximum peak perch of excitement and enthusiasm. The other piece is, look, ultimately, we're more of a domestic services economy than we are purely trade-driven. But we have to keep in mind, we're asking the market to bottom right now at 20 times earnings that are likely going down. That's a tough spot to sit in.
Jim was talking a 16 multiple on 26 numbers, which we mentioned would take you to just south of 5K.
Sure. If those 26 numbers, I mean, pick a number, right? But no, I do think, though, that the market has to sort of reserve this possibility that something here is contingent. They're going to say it's not negotiable, but they're
going to reach a pain threshold.
Right.
Yeah, they may or they may not. I mean, there is a belief, a thought out there that I've heard from others, and Jim echoed this as well, that this number, however you got to it, is simply designed to move manufacturing back to this country.
Right.
That is the ultimate goal. Now, it may be one that is ephemeral that you're really never going to be able to achieve. But if that's the case, and Megan's reporting is right now, it maybe is right a month or 2 months or 3 months from now. Maybe that's what the number's about.
I know, but to do that, you have to have companies willing to invest in the United States and to hire and to spend. And if they're dealing with now all of their supply chain becoming more costly and expensive. I mean, look at a Nike. Look what's happening to Nike right now. Yeah. Nike has its supply chain mostly in Vietnam, actually, and in China as well, where tariff rates have gone up past 50%, and they're in the 40s on Vietnam. And then ask them to build a factory to build shoes in the United States, where labor's more expensive.
Look, and where the policy might change just as the factory comes online.
Well, yeah, and it takes a few years for that. The other thing, you know, I just find a little ironic about this. And by the way, this is a knock on President Biden and on President Trump. Both of them have anchored their entire economic policy agenda around a return of manufacturing in the United States.
One was a carrot and one was a stick.
Both of them are lost in this world where the future of manufacturing is automation and robotics, which I know you've talked about, but it's just like, are we really willing to risk it all for that? My other point, you know, on the formula thing, you know, just to hammer this home a little bit more, state to state. U.S. states have deficits with each other. They're not cheating each other on trade and on tariffs. I mean, that just as a simple explanation for why these tariff rates, I think,
every
people
time
are so shocked by that.
You have a trade deficit with your hairstylist.
Guys,
does that mean you need to learn how to style hair?
Right, exactly.
We settled this hundreds of years ago. I mean, whatever the blunt instrument is that they're trying to use in this scenario, if it even worked, you'd be having the U.S. economy go down the value chain. Okay, your iPhone is designed in California and it's made in China, and that's worked out pretty well for us.
I just want to mention the U.S. dollar because there's a lot of noise about the dollar right now, and it's weakening.
Deutsche call.
Yes,
it's
a
weak,
big deal.
And people are wondering, okay, this was not supposed to happen, right? All the economists, all the strategists, U.S. tariff rates are going to go up, and the dollar's going to strengthen, and that's going to offset it. Guess what? The dollar's down 2%. That's a huge move.
Crash.
Why? Well, I think the two-year yield tells us a little bit about. There are expectations that the Fed is too restrictive, and they're going to have to lower rates because they're more worried about growth now than about the inflationary impact. By the way, inflation expectations are rising too. But dollar weaker on worse U.S. growth, on Fed needing to cut, on U.S. assets not being as desirable potentially.
Well, that's the thing, because our trade deficit gives dollars to the rest of the world, which comes back into our financial markets and finances our deficit. So there's a lot of links in this chain. I agree with your take on it, though. The market is, yes, 1 year inflation expectations are going up, but the bond market is just not pricing that, really. Market's pricing the risk to growth and what the Fed's going to have to do. Yes.
More weak growth. I don't think it's losing safe haven status. Gold's not even up today.
I mean, look, if we're above 100 on the dollar
Yeah.
index, we were there not that long ago, so.
Sarah, you don't believe, though, the theory that it's just about getting rates down? That's really all it's about? Because you've heard it.
mean,
I'm sure you've heard
cost?
it. Everybody wants to talk about that.
They're getting the rates down.
That's
Yes.
it.
They're getting the
Burning
rates
down the house to cook a steak. That's the line.
I think if you have followed President Trump since the 1970s, it's been the trade ripoffs, and this is very consistent with his views.
Right.
Mike, thank you. Mike Santoli.